So in this particular section, we're going to look at how to protect your investment, your watch ultimately, with this one thing called BCV. Now, in the course of your life here at Watch Trading Academy slash life as a watch trader, this word BCV will come up quite often, especially in our community, because you see, in 2005, I basically created this when I started my investment fund, and it was the dollar at which the investment was almost guaranteed safe. So when you buy a stock, for example, you're getting a non-tangible good, which is basically a digital piece of paper telling you own X amount of stocks. The money is like not in your hands physically, right? When you buy a home, however, you have an actual unit. So regardless of what, there will always be a cost structure to owning a home and a piece of land because they're tangible goods. Now, same thing with the watch market. In the watch market, you have what we call the bottom cash value. That is the lowest point of which something is worth in ultimately telling you to safeguard your investment. Now, many times, people get so scared in the watch game that they say, well, since this bottom cash value I'm explaining here in this video, I'm just going to buy everything at bottom cash value. Well, unfortunately, in the world of business, if we go to all buy things at their lowest point possible and always guaranteed everything at their best dollar possible, we would never do any business. So I'm going to teach you today a little bit more about BCV, how it actually works, why it actually becomes what it becomes, and then ultimately how to use it to make business decisions around watches that you need to acquire. So the first thing I'm going to bring up here is that it's called bottom cash value for a reason. Whenever a watch comes out, we're going to look at this as basically a chart, right? From the inception of a watch being ultimately brand new at a cost here, we're going to say, for example, $10,000 is the watch, right? Like that's what they're asking for at the mall, you know, for the MSRP. And then a watch has what we call a bottom cash value, which let's say it's down here. This is not for every watch the same, so please do not look at this and say, well, every $10,000 watch is worth $2,000. That is not the case, right? Let's say, however, a watch like something like an IWC or something along the lines of a Maurice Lacroix, some of these watches have what we call a 20 cents BCV, which means that they're ultimately worth $2,000. And all of this difference between the highest point of MSRP and the bottom cash value is basically the margin the jewelers play out. Now, I know at first glance you might say, well, that's a really bad example because which watch really has $8,000 in margin like that? Well, a lot more than you think. That's why you're here taking this training, and that's why there's so much money to be made in the watch game. Now, I'm going to use this example here just to show you, for example, that here the difference of how BCV works. So when a watch comes out brand new, it has a worth which is basically what the retailer, this is like what the retail MSRP is, right? And then it has what you call, under that, right? It has what you call a cost of retail, which is the lowest point that the jeweler buys this watch, for example, in order to sell it. And let's say that number is $6,000 as an example here. We're not using any specific watch. Then further down, you have what you call this margin right here between the BCV and that lowest point of retail called the wholesale market. This is basically people trading this watch between each other at various dollars up and down, ultimately to attempt to sell out of it to a retail client anywhere between this margin, 6,000 and 10,000. So you can see here, you basically have a 4,000 margin in between and a 4,000 margin on top, and that's basically the core of how the money is spread in a watch. Now, what ends up happening that a lot of people don't realize is that a watch's BCV never really changes. Its bottom cash value is also basically referred to as what I call the manufacturer cost. This is basically the lowest point that the watch will ever enter the market, partially because, again, this doesn't mean that there aren't exceptions to this, but partially because the cost of making the watch highly is at the same dollar as this BCV. So the way we think about this is, why would someone who is trying to buy margin want or not allow the watch to go further below BCV? Well, simply because nobody wants it. So if you ever see watches on the market that are extremely cheap, it's partially because, again, there isn't a market for that watch and nobody wanted it. So it is what we call the failed watch. The majority of watches will always trade be higher than BCV and lower than retail. So in this wholesale market, which is what you're learning here with part one, is basically how to wholesale a watch into this market here. Now, one of the things that I wanted to kind of explain from this BCV that people need to understand about how bottom cash value works is that each and every single manufacturer has its own BCV. And specifically in part 2, for those of you that are going to commit to watch trading and move on to the higher trainings we offer right here, I break down for you a specific chart of BCV for every brand out there that you need to be buying. So we cover that in detail. It's in more advanced training because that's my proprietary strategy that I don't want given away to just anybody. I want only serious watch traders to have it, partially because there's a lot of money to be made with that specific trading strategy. So right now, what I want you to understand is basically how BCV works, and that by buying at BCV, we're always protecting the investment. So an example with that would be that if we bought a $10,000 watch at $2,600, right, and BCV is $2,000, we would only be exposed $600 to risk, right? Meaning that we could never really lose anything more than $600. That would be the logical step of understanding how BCV works. The BCV is $2,000 like this example. We paid a little bit more into this margin. We're only exposed $600, but yet have a higher margin here, you see, all the way up to $6,000. So we have an upside of ultimately almost $3,200, $3,400, but I have a downside of $600. A very good bet to take in the market. So that's how I want you to kind of look at BCV as basically the safeguard for your investment. And then I want you to look at the wholesale market as the place you're going to be playing the most. So I'm going to wipe this for a second and have you go through this next section to kind of understand specifically how BCV plays into the sphere of how to actually understand BCV if you don't have the more advanced training or have not gone through part 2. And so I still want to show you that specifically on this page here. So when we talk about how do I find BCV, it's not going to matter as much for your wholesale career right here when starting trading. So when you start trading, BCV equals safety. It doesn't really matter from a dollar standpoint, like immediately where the BCV is right away, because you're only making one watch at a time investment kind of thing. So you're not going to need that again. And if you are playing with more money or are ready to kind of commit to this trade, you will need the BCV charts from part 2. But if you don't have them, there are still ways you can wholesale very safely. Because remember, we are playing in the wholesale game at this stage. It's very early. We're learning this process. And we're basically between, this is important to understand, wholesale is between lowest retail, right? And so this is the distance basically, and then at the bottom, BCV. So this is basically where you play in the wholesale game. And the way we figure out wholesale, which is really, really interesting, is we can call and actually try to trade in our watches to jewelers. So let's say we called a pawn shop. We would usually get the lowest point being the pawn shop. So pawn shops usually buy at BCV, so meaning they buy the absolute safest model possible. On the other hand, the jewelers have clients and they're constantly moving back and forth through these clients to get the most money. For that reason, they're always willing to pay a little bit more. So balancing out, calling pawn shops, offering your item or visiting or even talking to them or making friends with them on LinkedIn and then finding out what they pay for an item is just one good way to really look at that bottom ceiling. But even then, it's a little misleading because we're talking about buying that bottom, which is really hard to do. However, let's look at the secondary concept, which is calling jewelers. You have to find jewelers who specialize in the watches you're selling. So if you have a Panerai, you have to find a jeweler that sells a lot of Panerai. If you have, or let's say Maurice Lacroix, you got to find someone that sells Maurice. You got to look on the forums, etc., till you find someone that trades that particular brand. And then you basically want to act as if you want to trade them a watch and want to understand what they will pay you for it on trade. That is the dollar at which they are buying. And that is something very, very important to understand. So they are buying at that dollar, right? And so that tells you like the buy dollar for what I call a wholesaler, right? So this is the buy dollar wholesale. And then that continues to basically what they want to retail for. Now, the way you look at retail is basically you look at what they're listing for, not what they sold for, because you may not always know what they sell for. This is what you call right here, your margin of either profit or loss is in between these two numbers. The number the wholesaler or the jeweler gave you and the number that watch is listed online for, which you can see directly on some of these places like eBay or anywhere else. You'd see that difference right between the two, right? Very, very simple, very easy to manage, no issues here. Like, quite a simple gig altogether. So now you kind of understand how bottom cash value works, and you understand why it's so important to ensure that the bottom cash value is only used as a guide to guaranteeing the safety of your investment rather than anything else. And I want to show you some calculations here to help you understand how we look at if a deal is indeed a good deal or not, rather than looking at it from should I buy at BCV or not. Because I kind of briefly did that earlier, but I want to show you so you kind of understand. So let's say on a watch we have here, this is a chart for the cost. Let's say this is the BCV on a watch at 2,000 like we did, and this is their highest retail at 10,000 like we did, right? And we'll say here roughly that we were talking about buying a watch at $2,600, right? And we're talking here that $6,000, using the same example, was basically your lowest retail point, okay? So this means that the idiot that walks in the mall basically would pay this at the lowest possible point, up to 10,000, because it's just ignorant. So you have $4,000 here, and you have roughly about $4,000 between the 6,000 and 2,000 here, but you're buying the watch at 2,600, or even maybe, let's say 2,800, doesn't make a difference. It's that number and it's right in between. Now, one of the things I want you to understand is if you've called the jeweler and the jeweler had offered you 2,200, then you basically have a backup offer here. So your risk factor is only the difference between these 2 points, right? This is basically your error of risk. So BCV, jewelers may pay more than that or may not. You might see that your error of risk is here. So whatever that risk is, in this case, let's use the BCV as an example, that gives us a $600 risk. Now, you can also do what I call just calling ahead or seeing what you can ultimately sell for. So you can call others that have the same watch for sale, or look on Chrono24, on eBay, on any of these places, and see what that watch sells for. So you can see that watch might sell online used for maybe $4,200, right? Okay, so at $4,200 right here, somewhere around here, this is what you call your highest used. I'm gonna write it here for you. This is your highest used price, okay? So there's a couple of things you kind of have to understand. The average jeweler margin is roughly about 10 to 20%, depending on who's selling, right? Sometimes 10%, sometimes 20%. So the reason why I say you take the highest used price, and you have to be careful with that because you have to also know that it's within range. So the best way to find the highest used price is not to just take that dollar, but rather take 3 of average pricing and then pick highest one, not the average, but the highest one of the 3 higher pricing, as long as they're the averages of the prices on the market. So you take all the prices on the market and you go basically, it's between 4,200 to 6. Those are all the prices, right? And there's maybe one listing at 8. You look and you say, okay, the majority of these listings are between 4,200 to 6,000. So you go, okay, so what are my listings at for similar watches? Like make sure they're complete, they're matching what you have. And then you go, okay, that watch would basically sell for $4,650 in its highest and best case, right? So we know that now. And one thing you have to be careful of when looking at comps on the internet is you have to make sure you call and make sure that watch is available. Many listings are still left unattended out there, and pricing has risen, but no one has taken these listings down because they want to get leads from people who still think they have a low price and want to call in. So they don't do that. They don't take them down, and then it confuses you. Sometimes you have to call if you see a lot of disparities in the market and simply ask if the watch is available at that price. So you kind of know. So the way you would look at it here is basically, okay, I have my $4,200 here, my $2,600 here. Now, if I want a 20% margin, for example, then I'm looking here at the $4,200 and I'm saying, what is 20% minus $4,200? So I take $4,200, for example, I time it by 20%, that gives me basically $840 off, right? So that tells me that the lower point here is roughly $3,600. You see how this number keeps crunching into our $2,600. So now you're at $3,600 at its low point, right? Meaning that person probably purchased somewhere around here because they want to make 20%. So now look at this. Now you're seeing basically your margin here from what you paid, right, to the lowest possible point of resale. So you start understanding these numbers and you start making decisions about how your risk is basically spread across the board. Can you risk, for example, $600 here to make $1,000 here? Well, the bet is good because you have 1,000 upside in the lowest point possible, and even more, maybe even as high as 1,800 upside, like if you can sell at the highest possible retail point, but your downside is only $600. So it's a 3-to-1 odd that you're basically going to make the majority of your money on this watch, because even if you need to cut short and cut loose quickly, you would still be extremely competitive in the market space at a $3,600 listing and still make something, even if you had roughly 20% of the number coming out in fees and this and that, you would still make something. And that is the key here. That is why watch trading is such a powerful tool of investment, because it's almost impossible to lose unless you're buying the watches wrong. And buying wrong doesn't always mean buying not low enough, because one of the strategies we've always said about you guys trying to buy watches off of people is reminding them that they bought too high and they should have thought better, because they're not watch traders, just normal sellers. And sometimes you fall victim of that yourself, because other watch traders want to buy your watch and you go, oh, I paid $3,200, which is still good, even though it's not $2,600, which would have been better, or $2,200 would have been better, but it's not. But yet that person still says, well, you paid too much, and you go, yeah, I must have done that. And then you cut short and you take a loss when you really didn't have to. And so this is what I wanted to try to teach you about BCV and understanding how to price out risk to reward structure and ensure that you're not only buying at BCV, but rather buying at the right wholesale number, taking in consideration the investment risk with BCV rather than the other way around. Now, let's look at markers.